my macro work on liquidity says liquidity peaks out, not goes negative or does anything else, just peaks out by about June or July. So
of 25.
Of 25. So, but I'm seeing Twitter just tie itself in knots about that fear of the last stage part. And so they desperately want to sell earlier.
Yeah.
They're so scared of it that they want to sell earlier, which makes me think the 2013 cycle feels more similar, where everyone's going to try and take profit. The market goes down and then rips in your face again because it's not over yet.
After weeks of fear, doubt, and uncertainty due to several short-term headwinds, most notably the German government's sale of 50,000 Bitcoin, the cryptocurrency market has finally experienced a much-anticipated recovery. Bitcoin and other cryptocurrencies are once again on the path to higher prices, partly fueled by the impressive performance of spot Bitcoin ETFs. According to data from Farsight Investors, U.S. spot Bitcoin ETFs saw substantial inflows of $422.2 million on Tuesday, marking the highest peak recorded in July. BlackRock's IBIT led the inflows with $26.2 million, followed by Fidelity's FBTC, AR21 shares, ARKB, and VanEck's HODL, with $61.1 million, $29.8 million, and $22 million in inflows, respectively. Over the 3 trading days ending Tuesday, these ETFs attracted over $1 billion in inflows, signaling a very bullish trend for both the ETFs and the underlying cryptocurrency. Bloomberg ETF analyst Eric Balcon has posted an update on Twitter, expressing how the Bitcoin ETFs have exceeded his expectations within 6 short months. His post reads, "The Bitcoin ETFs are in 2 steps forward mode after 1 step back in June, with another $300 million yesterday and $1 billion for the week. The year-to-date net total has crossed $16 billion for the first time. Our estimate for the first 12 months was $12 to $15 billion, which is already cleared with 6 months to go." Eric anticipates more multi-million-dollar allocations to the ETFs in the coming days and weeks, foreseeing more interesting times for the cryptocurrency market and global liquidity conditions. Real Vision founder and CEO Raoul shares similar views, especially on global liquidity conditions, which he says are on the verge of turning. When this happens, Powell expects an instantaneous response in asset prices, predicting significant increases across all assets. However, he has particularly high expectations for the cryptocurrency market, which he describes as the fastest horse in the race. Between now and late 2025, Powell expects the overall cryptocurrency market cap to grow from less than $2.5 trillion to between $12 and $15 trillion, anticipating at least a quadrupling of prices for cryptocurrencies like Bitcoin, Ethereum, and Solana.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
I don't care what people's philosophies are. That's not how you make money. What you make money on is owning the best performing asset on a risk-adjusted basis. So what I tend to find is that the mid to upper part of the curve, which is networks gaining adoption, do best. ETH last cycle, Solana this cycle, and whoever it's going to be this cycle, whether it's Sui or whether it's Near or whatever it is, I don't know. We will see that, right? That is the easiest opportunity we get in this space to generate wealth. So firstly, focus on that. That's the do not f this up thesis. If we're going from 2.5 trillion to 100 trillion, do that and you'll make a lot of money.
Yeah.
And so then I just filter out as many people as possible. I really only get signal from a few people that I'll ever listen to. If you tweet something, I'll always read what you tweet because I think you'll have a high signal to noise ratio. Most people are high noise to signal ratio. And so I'll observe it for sentiment and any nuggets, but I try and filter out as much as possible and just stick with, unless something shows that network adoption is slowing, I'm right. So just capture that.
Right.
Then I don't FOMO in the rest. I just don't do it. I did that last cycle. I tried to spread amongst this narrative, that narrative. What I do now is really simple. It's idiot proof. I just put the chart against Solana. If something looks like it's a sustained trend against Solana, I'll allocate some capital to it. And again, only about 10% of my portfolio will I do in that kind of stuff. But you can make a lot of money in those. And so, that's what got me into WIF and Bonk because they were outperforming Solana. So I'm like, okay, I can do that. And now, if anybody shills me something, I just say, well, show me the chart outperforming Solana and I'll take a look. That discipline makes it ultra easy for me because I think because of this everything code liquidity cycle, everything is correlated, every asset in the world, which makes it and it's all driven by the same debt refi cycle, which makes it, I think, the easiest macro risk-taking environment of all time. Because the central banks have also taken the left tail out by saying we can't let collateral fall too far, so we will debase currency. Holy shit, if this is the case, then we have the simplest, easiest risk-taking opportunity of all time. So hyper-concentrate, I think, is the way. Now, there are people who can do the tail part, hyper-concentrate and get it right. But the probability is lower. And then you break the first rule, which is don't this up. Because if you get taken out in the cycle and lose your capital, and this cycle is going from 2.5 trillion to 100 trillion, that's bad. People are insanely fearful of the short stunted cycle, end of the cycle last time. And I remember the 2017 top and how bananas that was, and the 2013.
Yeah.
And like 2013, 2017 were much more similar than the last one. And don't forget, we'd gone through a global pandemic. There was a lot of other factors at play. So I'm like, that was probably the outlier. Don't expect everything to repeat perfectly. But like you, I'm probabilistically saying, well, it just probably goes to the end of the year. My macro work on liquidity says liquidity peaks out, not goes negative or does anything else, just peaks out by about June or July. So
Of 25.
So, but I'm seeing Twitter just tie itself in knots about that fear of the last stage part. And so they desperately want to sell earlier.
Yeah.
They're so scared of it that they want to sell earlier, which makes me think the 2013 cycle feels more similar, where everyone's going to try and take profit. The market goes down and then rips in your face again because it's not over yet.
Pal's thesis is that as liquidity conditions improve before the U.S. presidential elections in November, the cryptocurrency market will finally get the boost it needs to move from the boring zone to the banana zone, the phase in every crypto bull market where prices skyrocket and the market goes wild. The Real Vision CEO and former Goldman Sachs executive believes this hasn't happened yet because the Federal Reserve is maintaining higher interest rates to combat inflation. However, traders are now certain the Federal Reserve will cut interest rates by September. According to the CME FedWatch tool, there is a 91.7% chance that the Fed's target range for the federal funds rate will be lowered from the current 5.25 to 5.50% to 5.00 to 5.25%, with some traders even seeing a 4.5% chance of a cut at the end of July followed by another in September. By Powell's estimates, these rate cuts, along with potential stimulus checks and the resumption of quantitative easing policies, will begin before the November elections, causing asset prices to surge sharply. This aligns with his expectation that the cryptocurrency market will experience significant growth as these conditions materialize. Let's get back to Pal's video.
So there are two parts to what drives assets generally, particularly the ones driven by liquidity, long duration assets. Liquidity, is my belief, is not a flow of funds. It's just a pure debasement of currency. Inject money here, debasement there, asset optically goes up in value. So, because I went through this for ages, and this is what got me, I was mid-curving the whole damn thing for so long, because I was like, I can't see when there is liquidity or QE, there's no extra volume in the equity market. So therefore, it can't be doing anything. And that sat in my head for 2 years before I finally went, oh, because it's just re-rating. I saw it in the Cayman Islands over COVID. I mean, property prices went up 50% like that. It wasn't because they traded. They just went there because of liquidity. I'm like, okay, I'm starting to get it. It's this like magic force that we kind of don't see. And the global debasement is about 8% a year. So we're mutualizing the cost of the servicing the debt across everybody in the world by about 8% a year. And that's like a tax. The other way I looked at this, because at first, like, how dare they tax us? Then you say, well, what price would you put on a put option that your equities don't go down more than 30% and that your house prices are secured and the global economy is secured? Would you pay 8% a year for that put option? Yeah, it's probably not wildly mispriced.
Yeah.
You know,
that's so
and that's kind of changed my head. This is why I think we've taken the left tail risk out, because we're basically using this 8% as a put option in the entire system. So the other question you're asking is, okay, this is more about the flows, the actual flows. And I'm thinking here of whether it's into tech stocks or whether it's from fiat world to crypto land. that bridge, let's say the Bitcoin ETF bridge, which is, I think of as hot money flows and VC as foreign direct investment. Yeah. So what drives both of those flows is really simple. It's the business cycle. Why? Because when earnings go up, people have more money to invest.
Yeah.
And so the flows pick up. So right now, if we look at the ISM, it's still kind of below 50 and struggling to pick up. The forward-looking indicators are screaming higher. So it's about to pick up. But we're not seeing mass retail participation in crypto. Why? Because jobs are still a bit tight. The economy's still a bit shitty. People just don't have the liquidity. You know it from the VC business is nobody's had releases of liquidity, right? All the way from the stack, from private equity all the way down to growth VC, there's a real problem, except in the early stage token stuff. That's it.
Yeah.
So capital is trapped because there's no earnings going up. So if you think of Tesla stock, why is Tesla stock relatively low, even though it's got all of the technology stuff? Is because people buy cars when they've got money, and they don't have much money right now. Rates are a bit high. So that business cycle, as that picks up, now, again, if you go back to the everything code and the crypto and the macro seasons or crypto seasons, the macro summer is really when the ISM starts going up, earnings start increasing, and guess what? The world's awash with risk taking. So it's as simple as that, I think, which is why it's so beautifully on repeat.
As central banks begin cutting rates and easing their quantitative tightening policies, Powell predicts an exciting period for the cryptocurrency market, with asset prices expected to rise sharply or absolutely go bananas. He refers to this phase as the banana zone and expects it to commence at any moment. Unlike others, Powell remains optimistic about the US and global economies, attributing his optimism to central banks' tendency to intervene at the first sign of trouble. He believes they can't afford another global financial crisis, and that periodic money printing is the only way to avoid it. Powell expects this cycle to continue until at least 2030, when he predicts AI and robotics will drastically change the world. Until then, Powell advises investing in cryptocurrencies like Bitcoin and Ethereum to stay ahead of currency devaluation and debasement. He believes that these assets will offer a hedge against economic instability and inflation. Do you agree with Raoul Pell's analysis and his expectations for the cryptocurrency market in 2024 and beyond? Please share your thoughts, comments, and observations in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.